I want to welcome Jeffrey Christian. He is the managing partner of the CPM Group and has a long history of getting the silver market right. Welcome, Jeffrey.
Oh, no, thanks for having me, Elliot.
Yeah. No problem. I'm just really excited to speak to you because, every day we're inundated with emotional cries of what's going to happen to the silver market because of money printing, which is going to lead to hyperinflation. And it's not always backed up by the hard data, which everything you seem to talk about is backed up by decades of looking at the numbers. So I'm just excited to hear your perspective.
Yeah, we're very much fact-based and we do a lot of research. We've been the source for silver supply, demand, price data forever, since the 70s. And silver and gold have this quasi-religious quality that a lot of people have about it. And I guess the two things are scary. One, and part of it is they're unregulated markets compared to anything else. It's corporate law. Applies to physical gold and silver in the United States and in most other countries too. So anybody can say anything about them. And there is this belief system, and there's a lot of snake oil salesmen, But the really scary thing, that all of that's a problem. The other thing that's really scary for us is you have this very persistent mythology. Jerome Smith in the early 1980s, the world's going to run out of silver. There's not enough silver, and the price is going to be $100 by 1985. It wasn't. And we didn't run out of it. And we mined 19 billion. In 1981, we had about 7 billion ounces of silver reserves. In the intervening 40 years, we've mined 19 billion out of 7 billion. And we have 16 billion of reserves remaining. So we've mined, more than 2.5 times as much silver as the world thought it had in reserves in 1981. And we have twice as much reserves left. And that's a function of technology, but it's also very importantly a function of price. And people don't get it. But you go forward from 1985, we didn't get to 100. And then there's this guy who gets caught by the CFTC jerking around the orange juice market. And so he becomes a silver guru. And he starts saying, hey, the price of silver, there's this giant conspiracy to suppress silver prices, and it can't last. And it's going to blow up in Drexel Burnham's face because he had been working at Drexel Burnham. And the price is going to $100. There's something about $100. It's just, amazing magnet. Well, Drexel goes bankrupt, not because of silver, but because of other stuff. And so, I meant the conspiracy run by Merrill. Merrill gets out of the silver market. Well, no, I meant that the silver conspiracy is run by JP Morgan. But the price is it's going to blow up in their face within months, and it's going to be $100. And we have heard this consistently since the 1980s. That's not surprising because snake oil salesmen have been around since before the time of Christ, right? But what's amazing is that people still listen to these guys. It's like, how many decades does someone have to be wrong about the collapse of the financial system, the collapse of the dollar, hyperinflation, before you say, I just can't keep listening to you,
Yeah, that's why I'm happy I stumbled across you, because it was just like a breath of fresh air hearing the cold, hard truth of the silver market. So yeah, your team in the Silver Yearbook that just came out kind of proved that the demand and the supply are kind of steady, but the intangible is the investment demand. And so that's kind of where my questions are going to lead. And the first question, that kind of is the base for all of this, is whether or not inflation, the current inflation that we're seeing right now, is going to be transitory or not. Because, the gold bugs might say, okay, the trigger for the hyperinflationary event is going to be supply chain inflation. And then that's going to lead to a lack of confidence in, the whole financial system. But the first question is the supply chain inflation going to be transitory?
Right. Yeah. But you're right to focus on investment demand because that's the key driver for price. And our view is that what you're seeing right now is, several things that are transitory in the inflation numbers. First off, you're measuring year over year from April of 2020 when the world was shut down. and no one was buying oil, and no one was buying copper, and no one was buying lumber, and so if you unless you're measuring toilet paper, the inflation is year over year from very low levels. And the second thing is now we're starting up. We've had this amazing fiscal and monetary stimuli across the world. And the world is coming out of hibernation. It's coming out of the recession that it has been in. And demand for a lot of goods and services are rising. And a lot of what you're seeing is exactly what you said. It's supply chain. Now, if you look at CPI, which came out yesterday, or PPI, which came out this morning, it's interesting because the core inflation, ex food and energy, actually was higher than the headline inflation that includes food and energy. And if you disaggregate it, what you're seeing are strengths in or higher figures in inflation across the economy. There are pockets like new auto sales aren't all that great because you can't buy a new car because of the semiconductor problem, which is a supply chain thing. And new used car sales prices were up very sharply because people are buying more cars because they've been moving to the suburbs and the exurbs, and they need one car, or they need two cars, or they want three cars, and they can't get new cars, so they're buying used cars. And so you can see a lot of things that are transitory. And the thing about supply chains is there's always someone who's going to figure out how to get goods and services from A to B. So you don't necessarily, you're not looking at a structural secular upward shift in the price. You're looking at something that is a temporary factor until someone says, well, if you want to pay X for your avocados in New York, I will buy a truck and drive them to you.
Yeah, and that makes total sense. But then you have like the fear factor in the economy. Like yesterday, tech stocks plummeted because apparently they think that the Fed is going to have to raise interest rates to combat this transitory inflation. And if they do, that could just lead to the whole system to crumble. So is there a risk that, what should be transitory kind of leads to a systemic inflationary event that the Fed has to combat?
There is a risk and there is a probability, but when you start, coming up with probabilities of various scenarios, the risk of permanent high inflation and the risk of hyperinflation are extremely low. The risk of deflation is much higher on a long-term basis. And that's why if you look at the websites of any central bank in the world, and macroeconomists that are not mainstream macroeconomists or CPM Group, what you find is that there's a lot more concern about long-term deflationary pressures because of excess labor, excess manufacturing capacity, excess retail capacity, excess commercial real estate. And all of those things existed before the pandemic and the lockdown. And all of those things have been exacerbated by the pandemic and the lockdown. And it's accelerating some of the shifts in the way people buy things and the way people work and the way people travel and live, which are probably going to exacerbate the deflationary pressures in the long run. So if you think about it, I talked about how one of the problems with looking at high inflation numbers now and freaking out is that you're measuring it off of a very low base a year ago. A year from now, you're going to be measuring it off of a very high base. So we're going to have deflationary fears sweeping people who drink too much coffee. I don't know. Yeah. Hyper caffeinated, hyper worried people.
I gotcha. Okay. So the current fears, even if there is a fear that happens right now, it's gonna be short-lived because long-term, like you're saying, there continuously these deflationary pressures. Okay. Yeah.
Many people will move away from the inflation fears relatively quickly, but there'll always be people who are worried about hyperinflation.
Yeah. Yeah, that's right. So, okay. You're not concerned that potentially, the Federal Reserve is gonna pretty much this fear because, there is a fragility in the system right now because it's kind of, the Federal Reserve has put a lot of money into it. You're not really concerned that the short-term fear is going to kind of trigger something a lot bigger, like potentially in the, I don't know if you draw any parallels to the 1970s and how, there were like supply chain disruptions, which led to a lot of fear, which caused the bond vigilantes to cause the Fed's bluff and cause rates to rise and just cause like a big stagflationary snowball or anything?
Well, first off, the 70s, we could spend a couple days talking about the 70s. The 70s were radically different from what they are now. And one of the things is that the Fed until October 1979 targeted interest rates as opposed to inflation. So they let inflation run wild and they kept interest rates low until Paul Volcker came in and said, no, we have to slay the monster of inflation. But the other thing is, if you look at the root causes of the inflation that we saw in the 1970s, yeah, there were a couple supply disruptions, known as the oil embargoes 1 and 2. But in addition to that, you had this massive deregulation of not only the U.S. economy and society, but around the world. And that unleashed a lot of inflationary pressures that had been suppressed. And you can go from sector to sector, just take airlines. Up until the Carter administration, the FAA said, okay, you want to be an airline? These are the routes you can fly. These are the times you're going to fly. These are the number of seats in your plane. These are the prices that you can charge for those seats. Everything was regulated. And then they said, okay, we're going to deregulate the airline industry. And initially the prices went up very sharply because they had been suppressed by regulations. And then ultimately competition came in. It's the same thing as like buying a truck to bring the avocados to New York. All of a sudden, then ultimately competition came in and airline prices fell sharply. So, the 70s were exceptionally different. And going forward, everything pretty much changed after 2008 when the Fed changed its monetary policy and started paying banks to hold excess reserves. And that changed the whole mechanic. So a lot of people will look at macroeconomic correlations and they'll say, oh, from World War II to 2008, this is the correlation between the inverted yield curve and a recession. Yeah, but everything changed if the yield curve in 2008, 2009. And all of that history is history. Those rules don't apply to the relationship between hyperinflation and recession or inverted yield curve and anything. So going forward, there are a lot of issues that are there. We have concerns. They're not necessarily inflationary concerns. There are other concerns about the ability to sterilize the inflationary consequences of all the monetary largesse that you have. We think that that's going to be there. There are a lot of issues with sovereign debt and private sector debt that have to be dealt with. Those are going to be much more problematic because there is a political component in both of them, really. There's a big political component, and the political will is not there to deal with the enormous sovereign structural deficits and the consequent buildup of sovereign debt.
That's obviously what a lot of people are concerned about is the debt. So in this scenario, the Federal Reserve, do you agree the Federal Reserve cannot raise interest rates because it would just cause kind of a pricking of this big debt bubble in kind of every area of the economy? They can't.
In 2009 and 10, we were saying that we thought that Treasury rates would have to go up pretty sharply at some point. And then around 2011, 2012, we changed our view and we said, at some point, Treasury rates have to go up sharply. Some people say normalize, but it could be years or decades before that happens, partly because of the way monetary systems are running and Treasuries or bond market is operating, but just the pressure. Now, one of the things that we always tell people is you have to understand the Fed and the Treasury supply Treasuries, but there's a demand side of the market, which also has a say. And if you look at some of the upward pressure that we've seen since January, February of this year on Treasuries, that has not been the Fed saying, oh, let's raise interest rates. That has been the demand side of the market saying, no, we want higher interest rates. So, I don't think that the Fed can raise interest rates. The Fed doesn't want to raise interest rates. The Fed will raise interest rates when it needs to sterilize the inflationary complications. It'll also sell more bonds to stop up the excess money supply when the time comes. And it's made that very clear. But the Fed is only half of the market, the Fed and the Treasury. is only half of the market, and the other half are the people who are buying these things.
Okay, so this leads to kind of the big question, right? Because if the market wants rates to rise,
Mm-hmm.
and the Federal Reserve doesn't want rates to rise because there's a lot of, there's a lot of largesse and debt in the system, will the market pushing rates higher prick at sovereign debt and corporate debt and just even commercial and personal debt bubble if the rates do rise by market pressures, is the question.
That's one of the big risks. I mean, if you look at the tech stock bubble burst in 2000, 2001, if you look at the collateralized mortgage obligation and collateralized debt swaps obligations problems in 2007, 2008, and I'll offend some people, those are kind of like obscure corners of the debt market, right? Everyone focuses on the treasury. And I've used when people talk about U.S. confiscation or changing the dollar, I say, you guys are like the guy sitting on your house in the holler, and you're on the front porch with your shotguns waiting for the revenuers to come down the road. And meanwhile, they've gone in the back door and cleaned out your house. So everybody's focusing on the treasuries. The next crisis will come from some obscure corner of private debt. That's where these things blow up. I remember talks among central bankers and monetary authorities and sell side institutions, banks and brokerage houses back in the early aughties, where the authorities would say, we're kind of worried about this massive growth in derivative securities. And the banks would say, don't worry about it because it all nets out. And then somebody in the room, sometimes me, would say, it's not a problem if you can net everything out simultaneously, but you can't. That's not how netting out works. Somebody has a financial problem and he starts to unwind. And if someone is declared bankrupt in that daisy chain of borrowed securities, and the judge says, no, we don't unwind until we settle that bankruptcy, then you've got a problem. And you see that over and over again. So we're very much concerned about another financial crisis and a deep recession. We think one will come probably within the next 5 years. And it probably will be triggered by a debt problem in some obscure corner of the market that no one's paying attention to. Everyone's watching the Treasury and what's going to happen, if all of those Treasury securities that are held by American individuals and institutions offshore to avoid taxes. There's all this talk about how there's this massive amount of Treasury securities that are held offshore. And if you look at the Treasury data, they don't know who owns that. But there are estimates that it might be 30% of that stuff that is owned offshore treasuries owned by American corporations, pension funds, and individuals who are basically keeping their money offshore to avoid paying taxes on the profits. And they're holding it in treasuries because that way they don't have to worry about currency fluctuations. Those are much scarier than sovereigns, right? China has a lot of dollars. It will never do anything to hurt the dollar because it owns them. But if the US government comes along and says, you know what, we're going to start taxing profits on offshore American holdings, those are the guys who will jump on the springboard and push everybody into the lake. So that's a real concern that you have there, that you have these problems. But it's probably going to be some obscure part of the financial system that people are not paying attention to because everyone's focusing on the Treasury. The Treasury has all the weapons. I mean, the Treasury and the Fed are not low on ammunition, despite what the fearmongers who have been saying that since the 1970s. They have plenty of ammunition. The problem is going to come someplace where you don't have a lot of ammunition and you're the pariah in the market. And all of a sudden somebody says, pay up.
Absolutely. So that's another huge question. So, if there's a risk of a financial crisis, there's a lot of debt in the system, it's systemic, people are going to look to the Fed to have that ammunition to kind of put out the fire. So what ammunition do they have, if there is some sort of systemic fear that comes out of some sort of debt issue?
They have an enormous, almost open-ended ability to buy assets. Not just the Fed, but monetary authorities around the world. The Fed and the Treasury have greater power than other countries because we have this exorbitant privilege that is based on the dollar as a reserve currency. Yeah. So they have almost unlimited firepower in terms of buying assets and also issuing bonds. Yeah. So they have a tremendous amount of ability to increase money supply, and they also have a tremendous ability to buy bonds and support that and help keep interest rates down.
Right. So again, a lot of the gold bugs will say, but there's a point when the Federal Reserve, people are, foreign governments are just going to lose confidence in its ability because it's so, America's so indebted, and there's just only so much debt that you can issue. Like, look at, well, I don't want to draw the comparison to Weimar Germany because I'm sure you'll poke a huge hole in that. But just will there be a loss of confidence in the Federal Reserve's ability to buy assets and print money to do that?
There are people who have said that that's going to happen since 1980, and someday they will be right.
Okay.
But that someday maybe decades from now. We were working with central bank from offshore, and I won't mention who it is, but it'll be obvious in a second. This was 1981, 1982. And we were working with issues related to opening up their gold and silver markets because the central bank was the national market maker. It bought and sold, ostensibly it and its agent banks bought and sold all of the gold and silver in the country. And it also had its currency wasn't, it was fixed. It wasn't a free floating currency. And they wanted to go to convertibility of their currency ultimately. And part of that whole reform program was getting out of the national market making business in gold and silver. So I was a young guy, 26, 27 years old, and I was thrilled to be working with this massive, central bank that had this radical reform program. And they said, Mr. Christian, you have to understand, this is something that's going to happen over the next 30, 40, 50 years. Yeah, this isn't happening tomorrow. And they deregulated their gold and silver markets in 2000. This was 1981. 2001, 2002, they deregulated their gold and silver markets, and they're still moving toward convertibility. So there are issues about what the future monetary system is, but it's going to take decades from now to resolve them.
Because what would cause that lack of confidence would be kind of a collapse in the dollar, which would only be possible if like the euro and the yen spike, right? So is that why it would take decades? Because compared to other currencies, the US dollar is still the strongest and probably will be for the next few years relative, or?
Yeah, people talk to me, people say, CPM Group has been bullish on the dollar, and we've been more bullish than other people on the dollar. And we've been more right on the dollar for decades.
Right.
And I always say it's not that we're more bullish on the dollar, we're just less bearish on the dollar, and we're less bearish on the economy and on the US economy than we are with other countries. And if you look at it, our exorbitant privilege, which, that was Valéry Giscard d'Estaing when he was the French finance minister, I guess, coined that term. We have this exorbitant privilege because we have the reserve currency. 64% or 62% of central bank foreign exchange holdings are US dollar. So you can't run out of the dollar because it would be hyperinflationary for everybody else to try to create enough euros and pound sterling and yuan and things to replace the dollar. Yeah. And then if you look at private sector financial assets, probably 70 to 80% of that is in US dollars. So that's the first thing you have, and that's on the monetary basis. But then you have to look at the macroeconomics of the United States versus other countries. We have an incredible installed natural resource base. We have capacity for even more. We have we still have the best university system, although it's overrun by foreign students. It's like 75% of the STEM graduate students are foreign in the United States. And whereas if you go back 20 years ago, maybe 8 of the top 10 universities in the world were American. Now it's probably 5 of them. So we're losing some of that hegemonic capacity, but we have people. We have natural resources. We have installed manufacturing capacity. You look at what we did at World War II, where we were building, warships and tanks and bombers at an incredible rate. And we still have the capacity to do that kind of stuff, at least on a manufacturing installed basis. People talk about how the U.S. doesn't make anything anymore. U.S. manufactured output today is up something like 50, 60% from the 1980s. We're producing much more now, manufactured goods. And this is not ketchup like Ronald Reagan or George W. wanted to say that fast food workers were actually factory workers. This is real manufactured goods. We are producing much more today than we did in the past, but we're using half as many workers because it's all been either computer assisted or computerized or mechanized, and now it's going to computer manufacturing, not just with manufacturing, but also with services, including those fast food workers and farm workers, which takes that existing excess labor problem and exacerbates it multiples.
Yeah, we also own pretty much the big technology that is going to kind of lead to the deflationary events. We own the AI, essentially, the big chunk of it. We own the robotics, like just the mind around the future is American, right? Because we have the best universities and everything.
We're losing that rapidly. Yeah. But there's another factor that I'll talk about. It's very interesting. There's a British economist who I became good friends with, and I was on a platform with him in the year 2001. It was right after 9/11. And he said, I'm going to speak for 40 minutes. The first 20 minutes are about my lifelong work about how the dollar has to collapse, which got me knighted. And then the last 20 minutes are going to be about why I've been wrong on the dollar my entire life. And what he was saying was, if you look at the demographics of Europe and the United States, people emigrate to Europe to get away from political, religious, social, and ethnic violence and suppression. And they come to Europe because there's a state support system that will give them housing and food and education. The biggest embarrassment in 2001 in France is still the biggest embarrassment in France. It's a gigantic refugee camp at the mouth of the Channel Tunnel of people who have risked their lives to get to Europe, and they make a beeline for England, because once you're in England, then you can get to Canada, Australia, or the United States, and you can get a job. You look at immigration into the United States, people who come to the United States are not so much escaping suppression, they're coming for opportunities. So we also have an installed worker base, and we have a constant refreshing of that worker base, of people who want to come to America to work hard and try to experience the American prosperity. So we have a lot going for us, and that's going to keep the dollar strong. The thing we don't have going for us is the political will in Washington to channel all that stuff and do it the way we should.
Right. So we have a lot going for us, and that is going to offset the kind of the printing of the Fed when they do need to buy assets in the next deflationary kind of financial crisis, is what you're saying.
Exactly.
Okay. So that.
Well, let me just put that into one big thing, because this is the key difference between the way we think and the way some of the guys on the internet think. There will be future financial crises. There will be future recessions. These are cyclical developments. The financial system that's been in place really since the 14th century is not about to collapse. The dollar is not about to collapse because the U.S. has a lot going for it. We're not approaching the end of anything. We're approaching cyclical problems that need to be resolved.
Right. And you're saying that the Fed has the tools to do that. And I read Ray Dalio's book on the history of financial crises, and he did an extensive survey on the Weimar Germany. And they were able to debase their currency and just draw in, like once they did, it was just drawing a whole bunch of foreign investment and everything would do well and
Right.
great. But what stopped them was insane reparations,
Yeah.
right? But if it weren't for the unpayable and impossible to pay reparations, they'd be fine, right? Essentially, right? Because they debased their currency and that caused foreign investment and that caused growth. So they were able to get out of it. And same with Britain, right? They were able to, even though like at the bottom of when they lost reserve currency status, they were still able to come out of it. So you're saying great countries can debase their currency and come out of issues as long as they have a lot going for them.
Exactly.
So in that scenario, you are still bullish silver, right? In your presentation that came out this week, you're still bullish investment demand long term.
The consequence for gold and silver investors of what I just described as the difference between the way we think, which is really sort of like mainstream thinking,
Yeah.
and the arm waving bow tie guys who have been calling for the collapse of Western civilization for 40, 50 years. The big consequence for precious metals is if you see the price of silver rise to $50, check in with us. Yeah, we tell our clients, they say, well, okay, right now we're saying to our clients, in that next financial crisis, the price of silver could go far past $50, could go to $60 or even higher. And they say, so what do we do at that point? And we say, we call us. You're my client and you're asking our advice. And we'll tell you, okay, that's the last bullet. That's the last missile that's flying over the bunker. Or no, there's more to come. But at some point, you're going to see these prices spike higher. And we have record gold prices and record silver prices in our projections for the next five to 10 years. And the key difference is we say, when you see gold at $2,800 an ounce, sell it or keep it and buy puts against it. When you see silver at $50 or $60, sell it or keep it and buy puts against it. And you just look at a price chart, the price spikes higher and it comes back down. Why? Because these are commodities. And there's an enormous amount of gold and silver out there in refined form, held by people who say, $2,800, I paid $300 for this, take it. And there's even larger amount of metal that's in the ground that say, okay, at $15 silver, I couldn't really mine this. But at $20 silver or $25 silver or $30 silver, I'm going to do it. So you can see the prices spike and you will see the prices spike, but the spike doesn't stay there. It comes back down. And you just look at the historic price chart, that's the case. But there are any number of people who will tell you, no, this time is different. It's going to spike to $100 or $200 and stay there. And that's where you lose your money.
So that's your big takeaway, is just that, yes, even though there is kind of an inflationary scare right now, you're saying it's going to be temporary because the long term, because America has a lot going for it, the Fed has a lot of tools, and the deflationary cycle of automation and globalization and all that is going to offset any long-term inflationary effects. That is a big conclusion that investors should take away with, and not necessarily chase gold and silver if they were to spike incredibly high in this environment.
Right.
Great. So then I have to ask, last question is what will lead to America losing reserve currency status? Because that will be a massive scare, and I think people will be afraid at that moment and rush into precious metals. What do you think will eventually cause that?
When I started studying the economy at university in the 1970s, the US accounted for about 45% of world GDP. We now account for about 25% of world GDP. That's a long-term structural change that's continuing. If you go back to 1820, 1830, interestingly enough, China represented about 20%, a little over 20% of world GDP. India represented another 17%. So China and India represented half of the global GDP. The US was not in the top 10 countries in terms of GDP output. Russia was the third largest economy. France and England were smaller. But Russia, France, England, the United States opted into the Industrial Revolution, and China and India opted out until the 1980s, 1990s. Now they've opted in. So you can go fast forward, and in 20, 30 years, China has gone from 2% GDP to about 15, 16% now. And you can fast forward and you will see that China and India will be half of world GDP again. Russia, you went from 5% to about 1%, and the projections are that it might get up to 2%. They're kind of like, they really shot themselves in the foot. And you can see at the bottom of Russian Soviet thing. I studied communist economics, among other things, in university. That's what will cause the dollar to lose its hegemonic capacity, that long transition. Again, it's like, it's not, they're going to, no one's going to come down the road in the holler to confront us on the front porch. But slowly but surely, they're going to replace everything in the house with China made and India made and Indonesian made and Brazilian made and South African made products.
Right. Even though right now we own the Google and the Apple and Tesla right, we own that, which is kind of huge. And I mean, if we do own that intellectual property, we do have something to.
If you look at patents, the United States used to lead by an enormous span the issuance of patents. But if you broke it down, the US has these enormous patent advantage for pure discoveries. And Japan and Korea and increasingly China and now Malaysia and other countries are coming up rapidly in terms of patents on applications of the pure science that Americans develop. And that's been going on really for about 20 years now, slowly but surely. It's like, a lobster in a pot. You don't throw the lobster into a pot of hot water. You put the lobster in a pot of water and turn on the heat. And the heat's been slowly rising, and no one in the United States seems to notice that.
Okay. Excellent. Wow. Thank you so much. Just such incredibly valuable information for investors looking to take a position in something right now. So really appreciate it. Where can people go to learn more from you?
Hey, www.cpmgroup.com. And we have our weekly videos there. We have reports and presentations and articles that we've written there. So there's a tremendous amount of free resources at cpmgroup.com if you wander through the halls. And then there's also information about what you can buy. We came out with our Silver Yearbook this week. It's $160. It's an ebook. You go online, you buy it, and you have it. If you want a printed copy, you can take the PDF to a local copy shop, and for $12 in New York, you can have it printed and bound. But we have Gold Yearbook, Silver Yearbook, and Platinum Group Yearbook, which will come out in July. And we've been doing those things since the early 80s, and $160 each. They are tremendous resources. And then people, our typical client, I'll say a couple things. First off, we get more revenue from investors than from any other sector of the market. There are people who don't know squat about CPM Group, and they think that we do work with the sell side, banks and brokers. The sell side traditionally represents less than 1% of our revenue. They don't like us because what we do is we empower investors and mining companies and smelters to do better with their metals work. So we take the profits away from the banks and give it to the clients. And then we take a share of it. But most of our work is investors, and most of the people who buy our work don't say, I want to buy a gold yearbook or a monthly precious metals advisory. They say, I want an annual consulting package that includes your gold yearbook or your silver yearbook and maybe the precious metals advisory, but also some consulting time. Because when I'm sitting here on a Thursday morning and I'm seeing all these people freaking out over PPI, I want to be able to send you an email or pick up the phone and say, Jeff, what does CPM Group think about this? Yeah.
Yeah, absolutely. And you have a great YouTube channel too. And I watched the Silver Yearbook presentation, and like you just immediately debunked a lot of the myths, like we're running out of silver, and like the grades are going down, and
Right.
just a lot of the stuff that people that sell silver do want people to be afraid of, so that they buy it. So,
Hmm.
yeah, very, very valuable. Absolutely.
Well, thank you.
Yeah.
We
Uh,
tried.
yeah. All right. Well, does that cover it as far as where people can go?
I
All
think
right.
we did. Yeah. I mean,
Yeah.
the big takeaway is there will be crises, financial, economic, political. Gold and silver, we do think will go to record prices within the next decade. Uh, and it's not the end of the world.
This discussion is for informational purposes only. Nothing in this discussion should be taken as investment advice. Guests are not compensated for their appearance. Do not base any investment decisions on the information presented.